CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for July 27th, 2020. Please see our disclaimer for important information. So in the commentary this week, we're going to cover our high frequency data as we usually do. We'll cover the market in a little bit of detail, and then I guess some factors that we need to be paying attention to as we head a little bit closer to the fall and schools and obviously the election, things that we need to that certainly need to bear watching as we continue to fight the pandemic and try to make sense of the direction of the market. So the S&P last week was down 0.3%. That's the S&P 500. The Dow Jones was down 0.8%. The Nasdaq was down 1.3%. And the Nasdaq, interestingly enough, underperformed the other two indices, really on the weight of some, I'd call it, for lack of a better word, ho-hum earnings reports. As we're now getting all of those S&P 500 index, all the publicly traded firms are reporting their second quarter earnings, and we knew that the numbers were going to be bad for most people, but there were certainly a lot of high expectations being built into the technology sector, and aside from Intel, which I think left a lot of people longing for a better report, but there was also Microsoft and even Tesla, which was down 6%, on that news. And of course, that stock has been on a complete tear, but several things kind of really served as a confluence of some of the jitters as we kind of exited last week. Obviously, the coronavirus caseloads, which might actually be kind of tapering a bit in terms of growth in Texas, and perhaps even Arizona too. But I would urge you to look at our charts of the week for some detailed information on the trends in COVID. But obviously, we've got caseloads that are weighing on the conscience. We had the fact that we had more debate and political rhetoric with regard to the stimulus package, and a lot of stimulus is going to run out at the end of this month. We'll more on that in a minute. The jobs report, it looks like we've been gaining a lot of momentum in terms of the employment reports, really kind of dating back to late April and early May, and that progress, if you will, has kind of waned a little bit in the wake of some of the higher case loads and some of the kind of the retrenchings that some of the states have done in terms of opening their economy. And I mentioned the earnings reports, which I think in some respects have kind of been a little bit tepid. But if you look at the S&P 500 index, it's now basically a little bit below the break-even line year to date. The Dow, for its part, is down 7.25%, and the Russell 2000, which are kind of representative of small caps, are down 12%. Now the Nasdaq, even with kind of a rough week, was up 15%. And if you look at it, through July, to date, all three indices for the month, even after the jitters from last week, we're up about anywhere between 2.6 to 3.7%. So by and large, July has not been a bad month for the markets. Europe was up about 4.5% through today for the month, and is down 8.7 for the year. We look at bonds. Bonds are up about 1.2 month to date, and up about 7%. High yield and leverage loans continue to be underwater for the year to date. And as you know, some of the more real asset alternatives, including real estate, which is down about 14% year to date. The MLP index, which is tied to energy, is down 37%. Month to date, we've seen a little bit of rally in crude, and that's up about 5.3%, although still down over 30% for the year. And the other notable thing that we've seen is Treasury yields going down. And this will tie back into equity valuations, which we'll talk about in a second. But 10-year Treasury yield is basically 0.6%. It ended last week at 0.59%. It's down over 1.3% year to date. The 30-year Treasury is only 1.2%, and that's down about 1.1% from the beginning of the year. And so we've while we've seen some positive reports economic wise, some of those reports are kind of like hitting a little bit of rough water or turbulence, I should say. So some of the progress that we were making wasn't, didn't carry through July, and we kind of expected a little bit of curve in the momentum. In fact, looking at the high frequency data, that kind of bears itself out. And if you look at open table reservations in the restaurant industry, those were down from the last week about almost 4%. TSA checkpoint data was down about a percentage point week over week. And gasoline sales were down about 1.1%. And then we had some other things that were kind of positive. I think if in our charts of the week, we talk about freight, we talk about some durable goods shipments, and those numbers are actually not too bad. Looking at rail car traffic, that's up 7% over the week. Steel production is positive. Even hotel occupancy is positive. So some puts, some takes, but again, not as much momentum and optimism as we saw certainly this time last month. But the unemployment picture was a little bit muddled over the last week. Initial claims rose kind of unexpectedly to about 1.4 million for the last week. Now, continuing claims, which is one thing that we want to watch, is claims fell to about 16 million. And so that's a number that tends to correlate a little bit closer to the unemployment rate. In kind of other news, home sales, we've got some information in the charts of the week on homes, on the residential real estate market. Existing sales for single-family homes recovered to about 4.7 million units, which was a gain of almost 21%. And big news coming up this week, just to kind of get everyone level set, is the GDP, so economic growth for the second quarter. This will be the first reading, and we'll have 2 subsequent revisions before the GDP is finalized. But the number that we're expecting is anywhere between like a 26% drop to 40% drop, and I think the median estimate is for about a 35% drop annualized in economic growth for the second quarter. So that's the big news. Again, the market expects it, so I wouldn't be too worried about having some shock value in the market. Obviously, if it's down less than that range, if it's say down 25%, I think the market would probably react fairly positively. But a couple of other things going on. We've got China tension, and things kind of, I wouldn't say came to a head, but they're certainly working their way into kind of a real sticky wicket. So obviously we closed the consulate in Houston, and China ordered the closure of the U.S. consulate in Chengdu, and we're pressuring allies to rethink the ability to use Huawei technology and their 5G networks. And we've talked about delisting some Chinese companies, and obviously China's taken a hard stance, very provocative stance on security laws in Hong Kong. And I think just by and large there's still that thick air of negative sentiment towards China. So that certainly is going to continue to bear on our markets in terms of potential volatility. We've got a lower dollar, so our U.S. dollar was down. The dollar index was down 1.7% last week, and interestingly enough, it's at its lowest level since 2018. And while we've had a large number of caseloads for COVID's, we've had a caseload spike here in this country. Other countries are seeing a fair amount of mitigation, and so some of this may reflect that. There are positives and negatives to this. Um, you know, a lower dollar certainly helps exports. Um, it certainly helps cyclicals. It helps emerging markets, and but what it does is it increases the risk to the extent that we are, that we import from overseas. It increases the risk of importing inflation. And this inflation is something that we don't have right now. I think the surveys would suggest that it's not on everyone's mind right now, and probably disinflation is at least near term more likely. And we've talked about this in previous weeks, but over the long haul, inflation with all of this liquidity sloshing around is certainly something that I think we want to protect against. And to the extent that we continue to have uh, lower dollar activity, that could inspire the importation of inflation as prices are relatively higher overseas for goods that we would import. But anyway, so dollar's lower, and again, that has some positive and negative ramifications. We continue to have fairly narrow leadership, and in the markets, and we've talked about this quite a bit. We have kind of the big five, if you will, the Facebook, Amazon, Apple, Microsoft, and Google, and those five stocks alone account for 22% of the S&P 500. And a year ago, the top five were 16%. And when you go back to the dot-com bubble again, where technology had a very strong weight, the the top five were only 18%. So again, the market, especially in a weak dollar environment, would tend to support those. And if we go back if we continue to have restrictions in place, that would tend to favor technology. But again, the risk to this market is that uh, we have very relatively narrow leadership in the stock market right now. But having said that, people can justify high multiples because of what I mentioned before, that our treasury rates and interest rates are extremely low. And so if you have a lower interest rate, that would tend to support a higher price to earnings multiple. And as I mentioned, the 10-year treasury note is, it is just above, it's low from March 9th. It's under 60 basis points, and we've had yields on the 3, 5, and even the 7-year notes hit record lows. And so real yields are basically the most negative that they've been since 2012. And a real yield is just basically taking the nominal yields that I kind of just mentioned and subtract inflation. So even though we don't have a lot of inflation, if you subtract the inflation from these extremely and historic record low yields, that puts you into negative territory, which in turn is helping to drive gold higher. And I don't really see that necessarily changing anytime soon. So a lower dollar, in addition to lower interest rates, has certainly helped gold lately. But getting back to this fiscal cliff, I guess, if you will. Again, it's very politicized, very contentious, and I think there's going to be a lot of debate, even though Treasury Secretary Mnuchin has said that they feel like that they're kind of closer to an agreement. We won't know until we actually know. But what's going to happen to the unemployment support payments after July 31st? And we've got rising coronavirus cases, and the spike in cases, and the data that we can see, even in some of the high frequency where consumer activity is leveling off a little bit. That's a care and a concern that we have to monitor. So what's the impact of the rise in cases on mobility? Again, TSA checkpoint data was down week over week, and restaurant reservations that I just mentioned. Uh, what does this all look like if we have stimulus that drops off here in a week or so, or there's a gap in stimulus? So the impact there would be that 32 million Americans that are receiving unemployment insurance would lose thousands of dollars a month if the benefits stopped. And so this is a real choke point that, that $600 extra, what they call pandemic unemployment compensation, has really benefited a lot of people. And interestingly enough, without the expansion of those, that $600 stipend and expansion of eligibility to self-employed people and things like that through the PUA or the Pandemic Unemployment Assistance, the total amount of pay that would have been received by employed and unemployed workers through their jobs and from regular unemployment insurance would have been 6% lower in May than in February, and that would have represented the biggest decline in worker pay since the Great Depression, according to Sandy Leeds. And so instead, what we found is because of these supplemental stipends that the employee compensation actually was 3.5% higher. So, I mean, this is a critical program. Not speaking about it as an advocate per se, but it's clearly had a benefit in forestalling what would clearly have been a much worse situation. And then, also kind of related that economists, again, this comes to us from Sandy in some of his work. Economists at J.P. Morgan Chase Institute and the University of Chicago have found that jobless Americans are responsible for the bulk of the consumption recovery, which is really interesting. And if you stop and think about that employed Americans are still spending significantly less and saving more than before the pandemic. And we see the saving numbers really, really high. And a lot of those folks who were employed have had hours be cut, and in some cases their pay is being cut, but they're still employed. But those who lost jobs but didn't immediately receive benefits slashed their spending by 20%. So if the unemployed Americans, which are really by this study, again, just think about this for a second. So the unemployed Americans that were receiving supplementary unemployment insurance were driving a lot of the incremental spending. If we didn't have that incremental spending, and again, it runs out at the end of next week. If they don't have that, then that would have represented a fairly strong drop in overall spending. And that consumer spending number, which we have to look at because consumer spending is 70% of our economy, would have been dramatically different. So that was one of those aha moments when I culled through the research over the past weekend, and so take that if you will. But so we'll continue to get more earnings reports from a few companies. We're kind of at the tail end of earnings, so I think we know what we're looking at for the third quarter. There's still a lot of companies that are raising money, that are stockpiling money, that are trying to anticipate maybe a choppy fall where perhaps we do have growth, but it's maybe not as robust as we thought. It depends on the pace of the COVID-19 cases, particularly in some of these very important states like Texas and California that have such an outsized influence on the domestic economy, that if that were to persist, then you would expect perhaps a little bit lower growth. But if, like in the case of Texas last week, you begin to see maybe a leveling off in cases, and may look like wearing masks are actually curbing that R naught number, or that transmittal rate number that everyone's focusing on, that could put us into a much better place. Certainly, maybe latter part of next month and into September, and maybe sets up a better stage for consumer behavior towards the end of the year, net, and also all of these other second derivative things like travel and TSA checkpoints and open table and even potentially movie theaters. But job number one right now is we have to control the pandemic, control the numbers, and set the expectations bar, I think, a little bit lower. But I think there is light at the end of the horizon. There's a lot of therapies that have been discussed. The government's committing to buying at least from 4 or 5 different vendors that are in a clinical stage, at least phase 2, or maybe even preparing to enter phase 3 on these accelerated trials, committing to buying, literally tens, if not hundreds of millions of doses. So, and I think that there's more rhetoric out there that seems to encourage us to believe that they'll have some kind of a vaccine available for at least limited scope distribution by the end of the year, and mass inoculations by the beginning of next year. But like all, we'll have to see. Hope you've enjoyed this comment or these comments. And as things remain fluid, we'll continue to monitor the tea leaves and try to give you the news you can use. So appreciate you joining us this week, and hope you have a wonderful week, and please stay safe. If you have any questions, don't hesitate to reach us after the information provided. Be glad to respond in kind. And as always, we welcome your input.